Back in early 2011, $5,000 was a whole lot of money, but what if you taken that $5,000 and done something crazy with it? Not invested in the whole market, but bet on just 3 specific tech companies. We're going on a hypothetical journey back 15 years, splitting that $5,000 between Nvidia, Apple, and Amazon. The results, they're so staggering they barely feel real. That initial $5,000 would have ballooned into over $651,000. This is the story of how a pretty modest investment could have snowballed into a fortune. And it might just change the way you think about investing for the long haul. To really get this, you have to picture the world back in early 2011. The tech scene was exciting, but it was also messy and uncertain. The iPad 2 had just hit the market, and at the time, it felt like magic. The hottest phone you could own was the Apple iPhone for seconds. Steve Jobs was still leading Apple, though he would tragically step down later that year. The smartphone revolution was on, but with Android's market share exploding, nobody really knew what the future would look like. Remember when Netflix was just that company that mailed you DVDs? Its disastrous attempt to split into a second business called Quickster was a full-blown PR nightmare. Meanwhile, Blockbuster Radio had just declared bankruptcy. It was a time of massive change. Venture capitalist Mark Andreessen had just famously said, "Software is eating the world." But most of us hadn't yet realized the sheer scale of that takeover. In that world, companies like Nvidia, Apple, and Amazon were definitely known players, but their futures were anything but guaranteed. Nvidia was just the graphics card company for PC gamers. Apple made cool gadgets but was staring down a mountain of competition, and Amazon was the world's biggest online bookstore. A convenient place to shop, but Wall Street was constantly hammering it for not making enough profit. A bet on them was a bet on tech, sure, but no one could have seen the explosion that was coming. Our journey begins here, splitting that $5,000 three ways at $1,667 into each company. First up is Nvidia, and its story is easily the most dramatic of the three. Seriously, if you had told someone in 2011 that a graphics card company would become one of the most valuable corporations on earth, they would have left you out of the room. Back then, Nvidia was a solid, respected company that dominated a niche market of making powerful graphics processing units, GPUs, for high-end PC gaming. For years, our $1,667 investment just kind of chugged along, but behind the scenes, a revolution was brewing. Nvidia's leadership figured out that their GPUs were uniquely good at something called parallel processing, running millions of simple calculations all at once. This trick wasn't just great for rendering video game graphics. It turned out to be the exact kind of horsepower needed for scientific research and, crucially, for artificial intelligence. The company had been pouring money into a software platform called CUDA, which let developers use that power for things other than gaming. This was the pivot. While the world saw gaming company, Nvidia was quietly building the engine for the AI revolution. When the AI boom finally hit, really catching fire around 2022, Nvidia was waiting. Companies building large language models like ChatGPT discovered that Nvidia's GPUs were the only game in town. Demand became absolutely insatiable. Their data center business, once a small slice of the pie, suddenly became the main event. Recent quarterly earnings showed data center revenue repeatedly exploding, often by hundreds of percent year-over-year. Nvidia pulled off a masterstroke, shifting from just a consumer hardware brand to being the leader or backbone of the global AI build-out. The stock price, which had already posted respectable growth for years, went into hyperdrive. That initial $1,667 investment, After sitting quietly, it exploded into an almost unbelievable 56000. It's an incredible lesson in how a company's quiet, long-term vision can be completely invisible to the market for years, right up until it pays off in a historic way. Then there's Apple, a company that was already a titan in 2011. The iPhone had changed everything, and the iPad was creating a whole new product category. But Apple's growth story over the next 15 years wasn't just about selling more phones. It was about building a fortress and ecosystem so sticky it was nearly impossible to leave. Our 1667 bet on Apple was a bet that it could do more than just sell shiny boxes. While the iPhone was the star of the show, Apple played the long game, methodically expanding its kingdom. The App Store grew into its own multi-billion-dollar economy, creating a high-profit revenue stream for Apple. Then came the wearables. In 2015, Apple launched the Apple Watch. It entered a crowded field but became the leader by integrating seamlessly with the iPhone and focusing on health and fitness. A year later, it killed the headphone jack on the iPhone and introduced AirPods. What felt like a user hustle move at the time turned into a cultural icon and another monster business. Every new product wasn't just a standalone hit. It was another brick in the wall of the ecosystem. The more Apple stuff you owned, the better it all worked together. This created fierce brand loyalty and gave Apple the power to charge premium prices and maintain jaw-dropping profitability. Unlike NVIDIA's single, explosive pivot, Apple's journey was about methodical, relentless execution. It was a masterclass in turning a product into a platform, and a platform into a lifelong customer. That steady, compounding growth turned our initial $1,667 stake into approximately $4,700. It wasn't the wild, chaotic ride of NVIDIA, but it proved the immense power of a dominant brand with a brilliant strategy. And our third and final investment, Amazon. In 2011, everyone knew Amazon as the king of e-commerce, the everything store, but for investors, it was a frustrating stock to own. The company was famous for its paper-thin profit margins, always choosing to spend money on growth instead of showing big profits. Plenty of people on Wall Street wondered if it would ever be a truly profitable company. But hiding in plain sight was Amazon's secret weapon. Amazon Web Services, or AWS, launched back in 2006. AWS was born from Amazon's own need for a massive, scalable computer network to run its retail site. Then, they had a genius idea. What if they rented out that computing power to other companies? This was the real story. While the world was watching delivery drones and online shopping, AWS was quietly becoming the dominant force in cloud computing. It became the digital foundation for countless startups, government agencies, and even giant companies like Netflix. More importantly, AWS was a high-margin business. Its profits became the engine that funded all of Amazon's other ambitious and often money-losing bets, from the Alexa smart speaker to its huge push into logistics. By the time Wall Street woke up and smelled the cloud computing coffee, the stock was already on a tear. The retail business kept growing, but it was the cloud that transformed Amazon into a true tech behemoth. This dual-engine growth, retail dominance plus cloud supremacy, turned our initial $1,667 investment into approximately $4,400. It just goes to show that sometimes a company's most valuable asset is the one its customers never even see. So, let's add it all up. We started in early 2011 with a hypothetical $5,000, split 3 ways. 15 years later, here's how we did our $1,667 in Apple, the master of the ecosystem, grew into a very impressive $4,700. Our $1,667 in Amazon, powered by the secret engine of AWS, grew to a similarly impressive $4,400. and down $1,667 in NVIDIA, the company that quietly built the hardware for our AI future, skyrocketed into an incredible 56,000. You add all that together, and our initial $5,000 investment transforms into a grand total of $651,000. To put that in perspective, if you had played it safe and put that same $5,000 into an S&P 500 index fund, now, that's a fantastic return by any normal measure. But it's completely dwarfed by the explosive growth of these companies. Our little tech portfolio didn't just beat the market, it crushed it by nearly 20 times. It's a jaw-dropping look at the power of finding and holding onto legendary companies.
When you see a number like 65,100,000 from a 5,000,000 investment, it's easy to feel some serious FOMO, the fear of missing out. But that is not the point of this story. The real lesson here is about understanding what drives this kind of incredible wealth creation. This wasn't about getting lucky or trying to time the market perfectly. It was about seeing companies with a clear, almost stubborn, long-term vision. NVIDIA saw a future beyond gaming and invested in it for more than a decade before the rest of the world caught on. Amazon saw a future in the cloud and built it while everyone was just watching the retail numbers. Apple saw a future where all of its products and services would work together to create an experience more valuable than any single device. These companies didn't just play the game, they changed the rules. They survived market crashes, waves of skepticism, and brutal competition because they were focused on their long-term missions. The path from 5,000,000 to over $500,000 was not a straight line. It was bumpy and full of moments of doubt, but the key was holding on and believing in the fundamental innovation these businesses represented. This journey proves that true long-term investing isn't about chasing risky, short-term bets. It's a patient, disciplined approach to owning a piece of the businesses that are actively building the future, and hopefully, the staggering results from this 15-year experiment change how you view investing, not as a get-rich-quick scheme, but as a way to build real, life-changing wealth over time. If you found this trip through time valuable,